So we've heard about inflation and interest rates, and that's obviously been a big factor in market volatility year to date. The other thing, of course, has been particularly the war in Ukraine, but there's a lot of other geopolitical factors going on. I mean, we've heard just in the last few days, Xi Jinping has said they've now got Hong Kong and he still intends to get Taiwan. We've got midterm elections coming up in the US, and we've got a new Prime Minister in the UK who seems to have got off to an extremely wobbly start. Now, you know, the politics is certainly one thing, and markets worry about things whether Putin's going to hit the nuclear button and so on, but there are obviously also very specific impacts, economic impacts. I mean, we've seen things like Australian wine producers suddenly lose a major market when China decided they're not going to take Australian wine anymore. We've seen Europe potentially going winter without gas. And maybe one of the more obscure things I've heard was, I don't think anyone would have known that apparently all the Nespresso coffee machines in the world were actually made in the Ukraine. So to discuss this and how all of these things and more impact portfolios, we're going to have a presentation initially from Jonathon Costello from Western Asset, and then Jonathon will be joined on a panel moderated by Brett Sanders from Philo Capital, and joining them Chris Carrodus from Evidentia, David Berthon-Jones from Aequitas, and Matthew Swieconek from Findex. So I'll hand over to Jonathon. Thank you.
Thanks very much. I didn't realise about that Nespresso machine manufacturing, so perhaps that leads into the $5.90 coffee again. It's a real coffee theme this morning, and haven't had one, but a bit to digest. So hopefully we can get through a bit on geopolitics. Geopolitics, lots of risk is around and it plays a large part in portfolio construction. But we've seen throughout the last year or so what geopolitical risk can do to investment markets. The risk of geopolitical risk, its occurrence, is one thing that is very difficult to measure, but the level of impact on your portfolio is another thought. So what I thought I'd do here is just revisit how we got here and talk about inflation transition, which leans into the last topic that we had, and then just have a bit of a high-level overview of some of the geopolitical risks at play at present in the market and how they could impact portfolio construction, and then we'll lead into the panel conversation. So about a year ago, we were using the word transitory across the fixed income market in particular to describe inflation. And then those tailwinds to inflation, fiscal thrust, monetary accommodation and COVID reopening demand, they were being thought about, markets were thinking that inflation was transitory. But then we had the Russia-Ukraine conflict really put fuel on the inflation fire, causing higher commodity prices, additional supply-side disruption that had occurred through the COVID-induced lockdowns and the economic rebound. And then thrown into that, you had China COVID zero policy pursuits, and inflation really started to break out. The headwinds to inflation and growth, which were debt, demographics and technological displacement, had definitely gone to the back of investors' minds. Those long-term themes had gone to the back, and we started to pursue monetary tightening, increased pressure on real incomes and further risk to downside growth. Amongst this, there was a real issue with food security and energy security, and that's where geopolitical risks do play a major part. And when you're looking at that food security, the export of grain from Ukraine and Russia, around 25 to 30% of global wheat supply, was a huge factor. You had individual countries such as Egypt, which was importing around 70% of its grain from the Ukraine and Russia, and Turkey, which is 74% prior to the escalation, importing 74% of their wheat. So food security was a big issue. And then on the energy side, you had Russia supplying around 40% of natural gas to Europe and 10% of global oil supply. So Europe, they thought, okay, we'll put some sanctions on oil because it's not going to, central banks globally, coordinated effort. We'll put the sanctions on oil, probably hit Russia, but not affect Europe so much. But then Europe came out with its own weapon. They decided to play a few funny games with that Nord Stream gas pipeline. We've had some maintenance. We've had, sort of mechanical issues and definitely disruptions to the gas, and it's started to have huge impacts on European gas supply and gas security, energy security. So that's just played out in markets. We've had huge supply side disruptions. It's been exacerbated by this. And from a bond market perspective, that transitory word that was used, it seems that in the last few months in particular, that word unprecedented has been used much more often, and it's been used a couple of times in the previous session. So when you're looking at the aggregate index for context, and you can see 2022 standing out there versus other years of annual returns for the global aggregate index, you can see it really standing out, and it really is unprecedented. For bond market investors, looking at 94 as another tough year, you would take some comfort with 95 being a fairly strong recovery, but we do need inflation to moderate, central banks to get that under control before we can see a bit more stability in markets and some of that volatility that's moved across markets to dissipate. So we move to major geopolitical issues in focus at present. Pre this COVID-induced supply-side disruption, there are a few geopolitical issues on investors' minds, but we had a large backdrop of global growth to support economies. So individual economies had different drivers, but perhaps the geopolitical risk wasn't so severe. So we had US elections, whether they were rigged or not. We had protectionism, that nationalist agenda from China. We've spoken about some of those tariffs put on the wine industry. So Australia impacted various degrees, but China pursuing their protectionist or nationalist policies has affected many, many countries. You had Russia in the news, but the predictability of escalation of conflict in Ukraine was up to question, and climate change was definitely at the forefront of investors' minds. Now it seems that there's even more geopolitical issues at play. Got Russia-NATO conflict, European energy politics, Italian elections, a number of others on the list. So I thought I'd just quickly touch on a few, which I found pretty interesting to have a bit of a read about, and we can lead into the discussion. So in the European region, when you think about asset allocation, you can look at developed markets and emerging markets, but we'll start with Europe. And we've got Italy. It's the fourth largest economy in the euro area, and you've just had a recent election where the far right candidate Giorgia Meloni, she won the candidacy. She was the most right wing since World War II, and it's a party with fascist origins. As part of the coalition in Italy, you've got former PM, 86-year-old Berlusconi, who has been pro-Russia. So you've got anti-EU sentiment coming through in Italy, and there's questions as to how they'll be able to manage their debt that are ongoing, but also the future of the EU is always open to interpretation when you've got anti-EU sentiment coming from a very large participant. Then you look at Brazil, an emerging market. You've got that as the 9th largest economy in the world, largest in Latin America. And they are going through their second round of their political elections. On one side, you've got Lula, who has been in jail for 19 months before. He was on corruption charges, bribery. He's somewhat more socialist, but when you've got someone who's gone through those indiscretions and eventually been let out standing and is actually in the lead there, that's not a great circumstance when that's probably the lesser of two evils. And then on the other side, you've got Bolsonaro, who, he's definitely got thoughts about using the Amazon as a resource to be exploited. In Brazil, you've had deforestation at a 15-year high. It's up 48% year on year. And with the Amazon rainforest, the lungs of the world, you've got 60% of the Amazon in Brazil. And it really does play into climate change, climate policy, and the ability of investors to look through the economics and see over the long term how climate change is going to affect their investment portfolio. So from an emerging market perspective, that's an interesting case in point as well. Then just finally touching on China, you've got them pursuing COVID zero policy. The impact on global growth is severe if they continue to do that. They're pursuing that nationalist agenda, but at the same time you've got conflict that's ongoing between China and Taiwan. And when you look at Taiwan, they are a large manufacturer and exporter of semiconductor chips. And what I found really interesting is that China's largest import in 2020 and 2021 was integrated circuits. So I've got some stats here. When you put that in comparison to oil and other commodities, you've got integrated circuits in 2021. Imports were $390 billion US, China. Crude oil was about $230 billion, iron ore $173 billion, and petroleum gas at 61. So when you're thinking about the importance of semiconductors to the Chinese economy and their ability to advance and become a major power in global economics, Taiwan's very important. Taiwan does have a 60% share of the semiconductor market, and you saw in the last week or so, President Biden for the US extended a moratorium on the purchase of advanced electronics from the Chinese. So their ability to get high-tech equipment and also recruit highly experienced staff for their own Chinese companies to manufacture some of this advanced electronic equipment, it's made much more difficult. So software the same, very difficult to pursue the software from external parties, so they have to invest a lot of money. But so you'd see Taiwan as extremely important. You'd see their motivations for why they want to have a better foothold in that region. But at the same time, when you're looking at these electronics, it's extremely fragile. And that's the exact reason why they can't go in guns blazing and go in with full military force. So whether it's grandstanding and whether they're going to jump in and try and take over and get those manufacturing facilities under their command, that's questionable, but it definitely has implications for portfolio management when you're considering what's going to happen. So when you're looking at all those factors, as I mentioned, global growth has downshifted. Inflation is at play, and you've got central banks trying to control their own inflation within their regions. But if you don't have that growth backdrop supporting each economy, then perhaps these geopolitical risks are going to be much more of a factor going forward for individual growth of economies. So with that, we can lead into the discussion with the panel. Lots to talk about and see how people are going to construct portfolios with these sorts of issues in mind.
Maybe Matt, if you'd like to kick us off.
There you go. Switch the on button. That always works. So, firstly, Jay, you need to move to Sydney, mate. A double shot coffee is going to cost you about $5 up there, mate. And you can't tell me the coffee's 20% better down here, although you Victorians would probably say that otherwise. I do have a slide if we're able to bring that up. If Jenny, I've got the clicker. You gave me the clicker. There we go. That is not me. Okay, so I guess I've been asked just to talk about from a financial planning practitioner's perspective how we would take some of the geopolitical events and issues that have just been covered and spoken about today and policy issues into consideration when setting our asset allocation framework at Findex. So just to give some context as to our model, we have a strategic asset allocation that we will set, which is a 3 to 5 year time horizon for client portfolios. And we supplement that with a tactical asset allocation view, which is a 3 month forward-looking view that we set on a quarterly basis. And one of the elements, or I should go here, that we look at when we first start establishing our tactical asset allocation positions on a quarterly basis is an evaluation of the macro environment. There's a couple of other considerations that we look at, but the first is the evaluation of the macro environment. And there's two inputs that go into this evaluation. So firstly, we're looking at investor risk sentiment. We're trying to get an idea of risk aversion out there in the marketplace, and whether it's to borrow the phrase, a risk on or a risk off type environment, or whether we're sitting in a neutral position. And the way that we gauge the risk appetite of the market is via three different inputs there. So we're looking at equity market volatility. So we look at the volatility of different market indices across developed and emerging markets. We're looking at currency volatility. So we're looking at major currency pairs that are traded globally and the volatility there. And we're looking at the global credit spreads of risky debt, so emerging market debt and high yield debt. And I guess the wash up of all of this is really to give us an idea of investor risk appetite and investor risk aversion. Obviously, if there's high levels of volatility, credit spreads are widening, then there's an indication that there is risk aversion out there in the marketplace, and growth assets may be on the nose in terms of our tactical positioning. Excuse me. And vice versa, if we do have low levels of volatility and contracting spreads, then risk assets are somewhere that we may look to move. But of course, this is a quantitative framework that's used for this particular aspect, and we overlay that with a qualitative view on policy and politics. Now, what I should add here is that the research for all of these areas at Findex comes from State Street Global Advisors, with whom we've had a long-standing relationship. Obviously, they've got the breadth of personnel globally to be able to provide us with significant information in these areas around policy and politics in particular. So we ask State Street to attend our investment committee meetings on a quarterly basis and to present to us their geopolitical and policy and politics issues of the given day. But not just what those issues are, but whether or not they have a view that is divergent from the consensus. So there's obviously a consensus view out there for many of the markets or many geopolitical themes or events that take place. And so State Street will come to us and give us their views on whether or not they have a consensus view or whether they diverge from the consensus. And the whole objective of that conversation is really to say, well, if they do have an opinion or a view that differs from the consensus, is there an investment opportunity tactically that we can leverage there? So at a very simple example, the hypothetical situation might be there is a market consensus view on where inflation might land in the US and where terminal rates may end up as a consequence of that. State Street might come to us and say, well, look, you know what, we actually have a much more bullish view. We believe that the inflation outcome won't be as bad. The input prices that we're seeing and so forth are coming off. So as a consequence, our terminal view on rates is much less than what the market consensus is, and we're quite bullish on US equities. So that will then feed into our Findex tactical asset allocation view for that quarter, and we will consider increasing or taking on board whatever the advice is, either increasing US equities or long duration US treasuries, whatever the case may be. Is once the asset allocation piece is then provided to us, we then have we're quite fortunate, we have an internal research team of 7 analysts who are tasked with constructing the actual portfolios themselves from a bottom-up perspective across the various managers and ETFs and so forth that are available. Once our investment committee has signed off on those. So it's quite a robust process from cradle to grave, but I've probably spoken enough about the process there, Brett, and happy to hand it over to others for some floor space.
Thank you, Matt. Perhaps, Chris, if you could talk about your approach to asset allocation and I guess a little bit too about sort of, in particular, globalisation. Are you seeing that reversing, and has that changed the way that you've looked at portfolio construction?
Yep, sure. Happy to talk about that. Just maybe before I do, just to flog the coffee analogy. I'm from Melbourne now, live and work in Brisbane. I can get a coffee there for about $4 or $4.50, but I think it's a really good example of the difference between price and value. And I'd much more happily pay $5.90 for a Melbourne coffee than $4.50 for one in Brisbane. So there you go. I only got dropped into this yesterday, so I don't have any slides, but I'm going to steal one of Jono's. And I'm going to take a slightly contrarian position, which hopefully Jono's okay with because we've known each other for a long time. But I think you kind of want to, from our perspective, we want to think about, to the extent that we think about geopolitical risk, we want to be very clear about the difference between geopolitical events, which tend to be sort of short-term and isolated in nature, and geopolitical shifts, which tend to be long-term and more impactful. And the reason we want to distinguish between those two is primarily as an asset allocator. We are more interested in long-term and the medium-term impacts on markets, and less so on the short-term, and our ability to actually, we also need to be humble about our ability to actually identify and kind of add value through that sort of short-term dynamics. So actually can't see that slide anymore, but hang on, keeps dying on me. So if you kind of just look at this, I mean, what I would say the vast majority of these examples that Jono's used are sort of short-term, geopolitical events, so sort of local elections, cyber attacks, what else have we got there? Maybe climate change is maybe an example of a longer-term thematic. But from the vast majority of geopolitical events, they are, and my former firm BlackRock produces a geopolitical risk indicator and has done a lot of study around this. The vast majority of geopolitical events are short-term. The long-term impact on markets is very limited if you sort of strip out other factors. And then the other point is that they're very, very difficult to predict. So none of us here I don't think, have sort of walked the halls of Washington or the Pentagon and have real insight into the likelihood of wars or even elections, or even, frankly, any skill or a significant amount of skill to be able to forecast the impact and the likely outcome. So we need to be quite humble about where we think we can add value and where we can't, and that impacts, whether it's factored into a strategic asset allocation decision, a tactical asset allocation decision, or indeed a sort of a security selection decision. So I think the difference, and this sort of links onto the geopolitical question, which we'll expand on, is we do think that there is a shift that's happening right at the moment, and it's been touched on earlier around, which is probably started pre-COVID with the tensions in the trade tensions between the US and China in particular, and that's ongoing and perhaps being escalated now through the tensions with China and Taiwan, and then obviously what's happened with Russia and the Ukraine and the tensions with NATO, and then the flow-on effects to inflation, to energy prices, to interest rates, to economic growth. Those are much longer tail themes that really do, we think, impact into our longer term SAA forecasts, and so how we build portfolios from a SAA perspective, and then factor into how we make dynamic asset allocation decisions, and then even flow into how we allocate capital through to managers. And so an example of that, and I may have run out of time, is within emerging markets we are much more benchmark unaware, because if you think about, if you believe that in deglobalization or shifting supply chains as we do, then there's going to be significant winners and losers from that, particularly in emerging markets. And so you want to have the ability to be much more active around country selection, sector selection, and be much less benchmark aware in that environment particularly.
Thanks, Chris. Just while we're at that asset allocation level, one could argue that as globalisation became a force, that was this idea that to some extent you put ideologies aside, we're all sort of one part of a global market, we have vested interest, we don't want disruption, that we sort of march forward together with this sort of shared economic vision. But what we're seeing at the moment is that that's fracturing quite a lot, and that the world's starting to divide on ideological lines, on political value lines to a degree domestically. And that's a bit of a shock when it first happens. But it feels to me like we're starting to move into a pattern now where you can starting to become a little bit more predictable. So you talked about geopolitical events being hard to predict, but do you see signs that things are starting to settle and that sort of behaviours are starting to become a little bit more predictable as the blocks define themselves and the motivators start to become a little clearer?
I think just to clarify the point about predicting, it was really more around those short-term events, outcomes of elections, likelihood of war, even, in Russia invading Ukraine wasn't sort of widely anticipated until it happened. But I do think that the longer term, the points that I talked about, so the China-US tensions, that how it evolves is it's going to be slow moving, and I think it's less. There's less likely, not impossible, but less likely to be kind of an event around that, and it's more going to be a thematic shift. And you're seeing even recently further sort of crackdowns in technology sharing or provision between the US and China as sort of an example of that. So I think that those longer themes are becoming a little bit more predictable, and that's the point around them. Therefore, us having more confidence in reflecting that in our SAA and DAA views versus, say for example, a harebrained political decision by the new UK Prime Minister, impossible to predict that was going to happen, and outcome was pretty predictable if you knew it, but you didn't know it was going to happen, so we sort of looked through that.
Yep. David, perhaps if we can bring you in here, thinking about fund manager discussions and maybe pick the example of Saudi Arabia, that sort of choosing not to increase oil production, slap in the face to the US. I don't know how predictable that was, going back to Chris's point about we don't walk those halls of power, but are fund managers, in your experience, starting to take more overt geopolitical bets? Are they sort of talking about these issues more prominently than they have in the past when you've been meeting with them?
Oh, and the amount of it, I suppose. I was thinking of the little fist bump shared between MBS and Biden, and obviously if you'd used that to go along that particular trade, you would have failed. You would have lost money. I was parachuted into this 3 weeks ago, but I don't have any slides either. That will help me form my answer here. I actually do have one that I'll just bring up, if I may, with the clicker. I'm a DAA macro guy, and originally I thought that I was going to be talking macroeconomics, and so I prepared a slide which now I won't use in any great way, shape or form. Sorry, use the big button. Oh, okay. Well, the mystery will have to endure as to what I was going to show you. It was going to be amazing. Fantastic, thank you. So let us accept the premise of the conference in which deglobalisation and geopolitics are going to lead to an increase in cost. Oh, there it is. Fantastic. Thank you. Great. Across supply chains, and that quest for redundancy is going to be inflationary, and that central banks are going to respond to those inflationary pressures by continuing to ratchet up interest rates, and that those higher rates will be with us for a more persistent length of time. Well, from a managed fund selection process, what is one to do if they accept that premise? And so it would naturally lead you to examine, for example, your equity sleeve within a DAA multi-asset portfolio. Aequitas is both a fund manager and an asset consultant, and often when we first peek into client portfolios and look at the lineup of funds within the equity sleeve, we will see names like Ballygifford, Hyperion, T. Rowe, Benelong, and And as I look across the crowd and hear my esteemed colleague to my left chuckle good-naturedly, you'd recognise that as growth on growth on growth. And obviously, that's going to run contrary to the strategy that you've just heard about here with the impacts of geopolitics and deglobalisation and persistently higher interest rates. And so that might be a lineup or configuration that you might look to change. Its obvious corollary of the growth versus value factor dispersion comes prominently to mind. And then within value as a way of playing that factor dispersion argument, the fact that growth looks less likely to work in a world of deglobalisation, what managers do you pick? Do you go with the argument that supply chain redundancy means a greater claim on raw material inputs and therefore prefer to allocate to a value manager that gives you your enduring factor loading, but comes with a heavy sectoral allocation toward those kind of stocks and sectors that would benefit if those views ultimately prove correct? So, for example, a manager like Alan Gray that takes a very big swing might be preferable in that context to, say, a dimensional, where you're going to get your heavy value factor loading exposure, but it's going to be more evenly distributed across the sectors. So those kinds of consideration come to mind if you have a concrete view about what are the macroeconomic ramifications of deglobalisation and of geopolitics. But if you don't know, then you're going to be searching for sources of non-correlated ex-ante return, ideally low to negatively correlated with all of these macro bets that come from geopolitical dynamics and from deglobalisation dynamics. And so that might be your alternative risk premia strategies. I think AQR Delta has gone on to have the best year in a decade, possibly, if I recall my numbers well enough, after a long period of a significant drawdown. So those kind of non-correlated or lowly correlated to traditional equity and bond premia strategies look very good and very sensible in a world in which you don't have a clear conclusion, which is, I think, a point you were making about short run, who knows if Bolsonaro gets up. Short run, who knows if MBS suddenly decides to turn on the taps and increase production again. And who knows whether or not China decides to take Taiwan, or whether Vladimir Putin sees sense and gets out of Ukraine. And we can also add to that let us say you've got a slightly more firmer view and you want to go and try and play these uncertainties through equity market neutral type strategies. Well, do you then want to do that by taking sector bets that will arise within an EM equity market neutral type approach that's taken out the market beta, but still leaves you with significant style exposure, like a fire trail, for example, or if you prefer to neutralise the style and sector exposures, like what a Sage Capital does. All of those things are ways in which we can take into account through the managed fund selection process what's happening with this geopolitical dynamic backdrop and deglobalisation issue. But then I think to get to really what the crux of the matter is, it's the emerging markets for us. So it isn't clear that 20 years of globalisation and deeply integrated supply chain networks and increasing or ever increasing export shares as a percentage of GDP led to good things for the Chinese stock market. So maybe 20 years of deglobalisation will. I say that in jest, neither is clear to me. But I think you can add the ESG overlay to this geopolitical conversation. And if we think of the recommendation to go and buy Russian equities after the war broke out, well, that ran smack bang into the court of popular opinion in a fairly spectacular way, a very negative way. But that's an ex post consideration. A priori, thinking about for example, the Willie Packer Investigator Trust. So I'm a Perth boy, that's a fund of significant prominence in WA. I think they had a 20% active overweight to Russian equities in February, just prior to the war breaking out. And so, unfortunate for them, I suppose, but looking forward, is that the kind of risk that you're willing to take in your active manager, having such a significant bet on a part of the world that's known to be autocratic, bordering on fascist and openly hostile to the West? Probably not. And then the next question becomes, well, given that China has a stated intent to take Taiwan, does that mean that your active managers that give you emerging market equity exposure need to carve that out? Are you willing to back the odds of that occurring? Most people didn't think that Putin would go in because it was economic suicide. Most people think that that's a fairly good precedent in terms of argument for thinking about the South China Sea. But I'd say all bets are off for that to occur, and we have the historical precedent set, and we've got the stated words from the very recently held just over the weekend National People's Congress telling us that no, that's still very much the strategy.
We've got midterm elections too, so you could sort of say retreating to your ideological block and investing in, you know, the companies in democracies, that may not sort of help you too much either if you've got extreme tilts depending on who wins control of the American Congress. So, yeah, what does an asset allocator do? Is it a case of just spreading the bets? Is that as far as one can go?
That is a tagline that we use constantly with clients and are using it more than ever right now. Spread the capital far and wide across geographies, across styles, across sectors, making sure that there's no hero trades in the portfolio for what is essentially an unknowable political regional dynamic. I would also argue that the only trade that's worked really outside of hydrocarbons, and there was no way that you were going to have 20% of your DAA funds in commodities, or at least that's not within our risk appetite, our risk budgets, was long the US dollar. And so as you were talking about whether or not democratic countries have a risk premium that would be negative in this context, well, I think that you probably could say that.
Now, Jono, you've given us a fairly broad presentation, but your day job, I understand, is fixed income. Yeah. So when you're putting a portfolio together, I think we heard a bit in the prior session about, you know, perhaps focusing on quality. But for you, constructing a portfolio in this environment, anything additive that you'd like to talk about with the audience today?
Yeah, there's been a bit talked about asset allocation process and whether there's value or growth or different sort of alternatives. One of the hallmarks of our investment philosophy, there's two key tenets. One's long-term fundamental value, the other is multiple diversified strategies. Definitely, we have a realisation that we're not going to get everything right, so maintaining diversification is extremely important. I'd just touch on the diversification across those asset classes and agree it's been difficult to try and pursue a growth mandate now that discount rates have changed so much. But when you're looking at the bond market, it's been very challenging for the bond market and traditional asset classes over the last year in particular. But there are some pretty attractive yields out there that are available within what is your defensive asset class. So investors, they have had to reach for growth with bond yields so low, and they have diversified their alternative bucket within their portfolios, reaching for private equity, venture capital, infrastructure, for example. But now fixed income definitely is relevant again. You're looking at 5% yields within your Australian bond market, and then you can take some corporate exposure within that that is relatively high quality versus other regions globally. Talking about geopolitics and the impact on food and energy security, Australia's in a pretty attractive relative position. The lucky country again, where we do have exposure to commodity exports, so fairly resilient. And Jay talked earlier just about pursuing those sorts of businesses that have strong cash flows, that are regulated, ability to pass through inflation. Definitely, we do have a pretty high quality bond market. So just thinking about diversification, I think fixed income is a relevant and opportune investment.
We'd certainly look to echo those comments. I think from a balanced fund perspective, the target return is still 6%. If you can get 4/6 of that through your full faith and credit of the Australian government, that's very attractive on an ex-ante basis.
And just picking up further on that theme that Jay started with today about, you know, raw material producers being in a strong position. Do you agree with that? I'll ask each of you, and does that mean that we've seen portfolios in equities over the last 10 or 15 years where we used to have a very strong home country bias in Australia and started to use more global. Is this an environment perhaps where that starts to reverse a bit?
Who do you want to go first?
Let's start with Matt. I haven't heard from him for a while.
Well, certainly that's a position that we were taking and did take within our models, but that has, I guess, it's waxed and waned. But certainly still we still have a fairly bullish view on materials and hence, you know, an overweight position there with Aussie equities as a consequence. Not only there, but obviously in the financial aspect as well. We still think we're pretty well positioned. And look, if I can just build on what the colleagues were saying earlier on, the key for us really is not to take those really. We don't want to swing for the fences as far as our sector bets are concerned, and you know, we're always taking into consideration our client demographic as well. If we had a client demographic that was 30 years out or 40 years out from retirement, then maybe we might be in a position to take some of those more sort of bets, but you know, we're not, and we need to make sure that we listen to our client base as well in terms of what we're doing. So as a consequence, it just makes sense that we've got a fully diversified portfolio across styles. I mean, many would have been caught out 12 or 24 months ago when value wasn't necessarily the flavour of the month in terms of the management style, and growth was, but that changed very quickly. Now, who's to say it won't change back again at some stage? So if you've put your faith into one particular style and it turns out quickly, albeit you might be able to rebalance, you know, at various cadences. It's still too much of an uncertain environment from our perspective to really take those large bets.
Chris, anything from you on that?
Yes, on the sort of Aussie versus global equities, we're currently neutral. Our investment committee's on Thursday, and that's actually one of the things on the agenda. So it's sort of timely. And I think that your point about you know, commodity producers in the Australian market is part of the discussion. I think the other things that are part of the discussion for us are, and you've already seen that inflation for the moment is still lower here than it is in the US in particular. The RBA surprised to the upside with their rate move last month. So we think that probably inflation peaks lower, rates peak lower here relative to the US, which I think's probably got more work to do. So there's a sort of a relativity sort of tilting towards the Australian market on that basis. It's not conclusive, so we haven't discussed it, but we probably are leaning towards a slight overweight Aussie relative to international.
Good. Okay, and look, and the theme of advisors, you know, across a table talking to an investor who's, you know, one of the things the media does is provide a constant sort of stream of anxiety for investors, and like it's a fire hose at the moment. So the investor that says to an advisor, you know, I'm really worried about the war in Ukraine, I'm worried about inflation, or I'm worried about the prospect of further conflict with China. What's the scripting for advisors trying to have a sensible conversation with investors on these issues when so much is unknowable?
Well, when equity markets are at 2, 3, 4, 5 year lows, that's usually pretty conducive to a decent return going forward if one's time horizon is long enough. We wheel out that climbing the wall of worry chart that I think everyone has their own corporatised version thereof, the idea that since the dawn of human history, humanity and human ingenuity has overcome every challenge that's ever been thrown at it, ranging from prior pandemics to 2 world wars, and whether or not we're on the cusp of World War III. So, often as not, that can be fairly reassuring. There's the empirical argument that you can trot out, the attractive-looking returns across investment-grade credit or in government bonds, the fact that equity risk premia are fairly enormous at the best of times. They're a statistical abnormality, really, that reflects the fact that we are afraid of risk and taking on risk even when we're duly compensated for it. And I tend to mention the fact that, well, there's idiosyncratic variation across geographies. Right now, Europe, it feels like it doesn't pass the didn't you know test. Why would you buy European equities? Didn't you know there's a war? Didn't you know there's an energy crisis? And the fact that that narrative is so pervasive and so bearish, again, is usually not a bad time to think about proactive capital deployment. And there really is the possibility that Europe 10 years from now looks dramatically different. Instead of splintering along the axis of democratic governments versus autocratic ones, the West has banded together in fairly spectacular fashion. I know that there's the prospective rise of the far right in Italy, that there's the possible Bolsonaro, I will contest the election no matter the outcome type issue. But for the most part, at great personal cost, the West has drawn a line in the sand around Ukraine and said, all right, even though this will cost us dearly through Nord Stream being firstly asymptote down to zero and then finally bombed, we will stay together to promote democratic values. And I think that will lead to a true propagation of a banking and fiscal union. I think ultimately it's going to lead to deeper levels of globalisation. Sure, a particular supply chain proves itself unreliable, but then LNG is sourced from absolutely everywhere. At the same time, Putin will have inadvertently done more than Greta Thunberg to promote the adoption of renewable energies. And so 10 years down the track, when heat pumps are installed absolutely everywhere throughout Europe, replacing gas boilers, when EDF gets its act together and promotes, brings back online their nuclear facilities that have been closed for repair and maintenance, when Japan does the same thing, overcoming its aversion to Fukushima, when the German Chancellor agrees that closing and phasing out nuclear was premature and therefore costly, ultimately a wrong decision, and winds up in this happy state of completely achieving energy independence with a marginal cost of naught. That'll be massively deflationary, an enormous boon for humanity. Things could be brilliant a decade from now.
Brett, I might just...
Well, I want to just give the audience an opportunity, sorry, Matt, but we've only got a few minutes left, but anybody in the audience...
I'll defer to Matt, but my question was going to be, are clients asking these questions? You know, are clients fronting up and saying, I'm worried about China, or, you know, are they addressing these geopolitical issues?
Perfect segue. Yes, they are. So we've got 110 advisors around the country, and many of them are fielding these questions every day because they're seeing all sorts of press and becoming concerned as a consequence. We are fortunate, we've got a lot of clients who have been with us through various downturns and so forth, and for those clients, it's, I won't say just another rodeo, but they have been through this before. I guess, look, we try and keep it very, very simple by saying, look, this is different than the catalyst this time around is different from what it has been previously. But guess what? So was 2020 when COVID came along. We hadn't had a pandemic previously. Credit crunch back in 2007, 2008 when the GFC occurred. Nobody had ever heard of CDOs and these sorts of things. That was all different in terms of the environment then. The dot-com boom and bust. The catalysts are different each time around. The market capitulates and it has a sense of reverting to the mean over a period of time. Yes, this time around it is different in that we have had fixed income and equities, fall together, and that is something that is unusual. But it is really a sense of saying, look, if you're an investor for the long term, we have been through these things many, many times beforehand. The catalysts are different, but the outcome's typically the same in terms of the long-term returns and performance of the market, so long as you're holding good quality assets and managers and so forth.
Time for one more, if there's one out there.
I just maybe got something to add to the advice. Oh, sorry. Go on.
There was a slide showing. Yes, thank you. There was a slide showing like 30 years of history from 100% or 100 points to a fan of different outcomes. 1994 and 1995 were adjacent, very different outcomes, and 2020 showed something which was just plummeting. Sorry, 2022, I think it was plummeting. Who's going to be brave enough to pick that turning point that 1994 and 1995 were?
I'd take that question. I think it's worth just remembering with fixed income as an asset class, it is mean reversion, the key is you want to avoid defaults to get your money back. So when talking through with clients the challenging period that we've had over the last year or so, it's sometimes hard for them to understand what duration means or how credit spreads are wider than they were, where we got in the height of COVID uncertainty. But when you talk about the high quality nature of some of the corporate exposures, and for example, you have a 4-year bond on issue at the moment from Air New Zealand. It was issued at 5.7%. It's got 51% ownership by the NZ government, and it was issued at 5.7%, but now it's over 6%. You go back to, okay, will you get your money back? Are they going to pay the coupons as they fall due, and are they going to pay at maturity? So you've got to hark back just to bring comfort to clients who might not understand so well. And when you're looking at this chart, it's definitely very difficult to pick the turning point. But again, if you've got the long-term horizon, then you have a high likelihood of getting your yield to maturity and active management opportunities on top. So path forward, it might be challenging, but some pretty attractive yield to give that backstop for more capital movement.
All right, look, we're running a little bit behind time here, so we better end it there. So please join me in thanking Jonathon and the panellists for what's been a very interesting session.